First off, I would like to thank you all for taking the time to join me today, and I really hope this webinar will be worth your while. I am Nady Laymoud, and this is part 2 of Mental Success Practical Steps to Master Your Trading webinar series. This time, we will discuss money management. My main challenge while preparing this webinar was how to present a webinar about money management and in the same time, keep that webinar free from complex mathematics and formulas. You see, I'm by no means a mathematician, and needless to be said, I'm not a programmer. Actually, I envy those who find beauty in numbers. My knowledge in mathematics is as much as the next guy. But 2 years into my trading career, I figured out that I have to use proper money management if I wanted to further improve and maximize my profit. The truth is, we are all using a money management strategy, whether we are aware of it or not, as we will soon discuss. There are two main problems with money management literature. First, most of the books are written with a single strategy in mind. So we do not get the luxury of comparing strategies till we read many of these books. The second problem is that money management books are mostly written by mathematicians for programmers or vice versa. Few of these books focus on traders like us with no advanced knowledge in mathematics or statistics. Without further ado, here are some of the benefits using the proper money management technique that I would suggest toward the end of this webinar. It would take 59 consecutive losing trades to lose 90% of our equity. Well, that's not new. We all know that using proper money management can help us preserve our capital. It will take between a minimum of 10 consecutive winning trades to double our capital and a maximum of 18 consecutive winning trades. Well, that's quite good, but real life trading does not work like that. It's not common to have a winning streak of 18 or even 10 trades. Most of the time, there will be a losing trade that might cost us 15 to 30% of our capital. That is called drawdown. So here comes the next promise. Drawdown per trade is a maximum of 4% of capital. Now, this is becoming interesting, but still having such money management system can take a long time to prepare before each trade. The suggested money management system would take 5 minutes to do the simple calculation manually. And if you use an Excel sheet or a simple money management system, like the one we are going to discuss, it will take a maximum of 2 to 3 minutes. Before we go any further, let's do a quick recap of what we discussed in part 1 of this webinar. In the last webinar, we explored the trading pillars. Trading psychology responsible for 60% of trading success. These percentages were assigned by major authors, money management with 30%, and finally, technical analysis with 10%. We also mentioned how these percentages are not the important factors. Sorry about that. We can cut these percentages in half and still find value in trading psychology and money management. From a practical point of view, we should set the priorities of the trading pillars right. The most important pillar is trading psychology. Why is that? Because simply, if we are not psychologically prepared or we lack the needed discipline, we will not be able to follow a technical analysis system, even if that system is profitable. Failing to follow our system rules is the sure way to lose in trading. To clarify, let me ask a question. What is the difference between demo trading and real trading? We apply the same analysis on both types, and we use the same money management strategy. And of course, in both types, we are trading real market data feed. So why most of us end up winning in demo trading, but fail to do so in real trading? The answer is trading psychology. Having a successful analysis system, whether it's technical or fundamental, is the second important pillar. Because without a proven successful system, exactly, Robin, exactly. The second important pillar is an analysis system, because without a successful system, we will not be able to create profit. And lastly, setting the money management strategy, because the truth is, no money management system can make us profitable without first having a successful analysis system. The good news is successful proven analysis systems are available if you spend time looking for them. And if it's not your thing, you can always subscribe to a technical service that you trust. So to recap, our priorities should be fixing and managing our psychological behavior, then follow a proven technical or fundamental analysis system. And once we get both items covered, we should focus on our money management system. Analysis tells us what the market is, where the market is probably going, either up or down. Money management strategy tells us how many lots we should invest in that single trade to follow that analysis. Now, let's quickly review the 6 steps we talked about in the last webinar. The first step was a preparation step. It was setting our goals. We talked about how all of us have one single goal, which is to make money. But that is a broad and abstract goal. In order to succeed, we have to break it down to simpler goals. In the second step, we talked about how we fail to accept risk and how we would hold on to a losing trade against our best judgment. To remedy that behavior, we have to accept our risk, allowing few of our trades to form small losses, as it's inevitable. We should cut our losses short by sticking to our stop loss point. So the second step was having a firm stop loss point and never moving it once in trade unless to trail profit. In the third step, we viewed how we can be driven by fear of missing an opportunity when scanning for a trade, and that results in rushing into a trade without proper analysis. Trading based on a whim or an impulse is disastrous, and to protect ourselves from that behavior, we try our best to avoid entering a trade at market price. Rather, we wait for the right moment and for confirmation. Therefore, the third step was to use confirmation point as an entry point. In the fourth step, we examined how we forget that it's really hard to think rationally when we are invested emotionally and financially. That's right, Robin. But there's a huge difference between making a 10% profit and making a 30% profit. Money management can turn a 10% profit system into a 30 or even more profitable system. This is why we are talking about money management today. So in the fourth step, we examined how we forget that it's very hard to think rationally. And no matter what we do, we will always feel the pain and discomfort when in a losing position. No one wants to be proven wrong. Therefore, our minds try to protect us, as they always do, by blocking market information that proves us wrong. All it provides us with is the information that agrees with what we identified as right, to keep us from feeling that pain and discomfort. And once we exit a losing position, we can clearly see that we were going against the trend, and we wonder how we failed to see the evidence. So to counteract our mind's protective functions while trading, we have to prepare an alternate scenario before placing a trade, just to restore our ability to clearly see the market direction without our mind protective interference. In the fifth step, we discussed that once we master the past step, we will be on our way to financial stability, and we will notice our attitude change towards the market and how better we become at trading. With the game changes, we find ourselves facing new bad psychological behaviors. So we have to prepare for that change of input we bring to our trading. This point was all about withdrawals. As it keeps us focused and aware of our goals, glad to hear you can hear me. It adds a psychological benefit, and it should be performed periodically. The last step we discussed was how to evolve. Every system, no matter how great it is, can be improved. It is in our nature to seek perfection. We cannot achieve that perfection, but we can always improve and evolve. If we have a success rate of 70%, we can improve that to 75%. If it's an 80%, we can improve it to 85%, and so on. The most important point we should keep in mind is that we should only focus on this stage once we reach consistent success and where our curves reach a plateau. Now, let's move on to money management concepts. The first concept we are about to discuss is reward to risk ratio. This is the ratio between what we are willing to gain divided by what we are willing to risk. So, if we place our stop loss 20 pips away, then we are willing to risk a loss of 20 pips. And if we place our take profit 40 pips away, then we are willing to gain 40 pips. Quite simple. To follow this concept, we divide the profits by risks in pip. So in the example, we divide 40 by 20, which would result in 2. If the result of that division is less than 1, we should not enter this trade. But if the result is higher than 1, preferably much higher, then we can enter that trade. This is an important concept because this concept reveals good opportunities from bad opportunities. As we mentioned, a good reward risk ratio should be at least equal 1, meaning that we are willing to gain as much as we are willing to risk. If we risk 20 pips, we expect to gain 20 pips. That is a good reward to risk ratio. An ideal reward to risk ratio should equal 2, meaning that if we risk 20 pips, we are willing to gain 40 pips. And the perfect reward risk ratio should equal 3, meaning that we risk 20 pips to gain 60 pips in return. The second concept is drawdown. That big term simply represents loss. If it's calculated per trade, then if you risk a 40 pips on a single trade and you lose, you have a 40 pips drawdown. And if it's calculated by equity and you risk 10% of your capital and lose, then the drawdown would be equal to 10%. Knowing the drawdown in advance and controlling it can help us protect our capital, as we will shortly discuss. Next, let's quickly go through the differences between accounts types, standard, mini, and micro accounts. I believe you are all aware of the differences between these accounts types, right? Basically, one standard lot would have a bid value of $10, while one mini lot would have a bid value of $1, and lastly, one micro lot would have a bid value of 10 cents. From a standard account point of view, one standard lot would equal 10 mini lots, and one standard lot would equal 100 micro lots. From a mini account point of view, one mini lot would equal 0.1 standard lot, and it would equal 10 micro lots. And from a micro account perspective, one micro lot would equal 0.01 standard lot and 0.1 mini lot. So, why are we discussing such basic knowledge? Because lots of traders ignore the flexibility we get using a micro or even a mini account. Using any money management strategies, we will be faced by a situation when that money management strategy suggests entering the market by 1.5 lots. If we are using a standard account with no lot fractions, then we would have to choose to either enter the market with 1 lot or with 2 lots. The problem here is this. Entering the market with 1 lot would mean that we are risking less than what we want, and in return it means that it will take more trades to double our account. On the other hand, if we entered the market with 2 lots, then we would be risking more than we should, and it would take us longer time to compensate for a loss, and that can hurt our capital. Now, if we use a mini account, that would mean that we would be able to follow we will be able to follow our money management system to a certain extent. That flexibility is even maximized using a micro account. Let's view these graphs and try to understand what they mean in terms of account types. Sorry about that. These graphs assume that we are starting with a $10,000 capital, and it explains the lots traded to reach $20,000 capital, or in other terms, duplicating our account. At the same time, these trades agrees with a decent money management system. Using a mini account shows that at times we would be forced to use a lot size not adequate to what we see fit, just because a mini account does not provide us with the needed flexibility in trading. In this example, we would have to stick to four lots for a long time before jumping to 5 lots, even though from a money management perspective, we can slightly increase the lot size to, say, 4.8 mini lots without worrying about excessive risk. We end up with a stepped line as we see in this chart. So, using a mini account, we would need 21 consecutive winning trades to double our capital. While, on the other hand, using a micro account, we can see how smooth that line is because of the added flexibility, and as an added benefit, we would only need 18 consecutive winning trades to double that account. What we will find is that we cannot practically use a standard account with a proper money management system if our starting capital was $10,000. While in real world, you will find that most new traders use a standard account with such capital, even though using a micro account would get them to where they want much faster and safer than using a standard account. For the record, a reward risk ratio of 1 was used for the calculation of these graphs, and using a reward risk ratio of 2 or even more would lessen the needed trades to double the capital to 10 consecutive trades or even less. Now, let's move to the money management strategies. First off, allow me to ask, what is the success rate of your technical analysis system? Is it less than 60%, 60% to 70%, or 70 to 80, or more than 80%? Duplicate the lot size once you encounter a loss. So if you were trading with one standard lot and you encountered a loss, you upgrade your next trade to 2 standard lots. This type of system might be of value to gamblers, but to Forex traders, it's practically of no use as it requires unlimited funds to realize profits. Every strategy we are going to discuss from this point forward is considered an anti-martingale strategy. We will discuss 5 strategies. First, fixed contract lot size strategy. Second, Kelly's Criterion. And the third strategy is fixed fractional strategy. The fourth one is a variation of the fixed fractional called optimal F strategy. And lastly, we will discuss fixed ratio strategy. So the first one is fixed contract lot size. This is the most basic strategy, which new traders use as in their trading. It depends on a fixed value that we follow no matter what happens to our capital. It really is simple. We use one standard lot size per trade for our $10,000 capital. And when our account grows and reaches $100,000, we keep using that same one standard lot size per trade. The advantages of using such a strategy, even though it's really simple, is that it's really easy to understand. So it gives new traders the needed time to perfect their trade execution and give them the time to focus on their analysis. Of course, it's really easy to manage since you do not change anything prior to starting your trade. The disadvantages of this strategy is that the account or the capital never grow exponentially, meaning that this strategy limits your analysis from realizing its full potential, and therefore requiring much more time to double one's account. The next strategy we are going to discuss is called Kelly's Criterion. This is the second oldest strategy out there, which is based on a paper by J.L. Kelly in 1956. The paper itself was based in probability theory, and it was about sending data over telephone lines and had really nothing to do with trading, but the formula was really adapted later on. This strategy is loosely called strategy. It needs a lot of modifications to be tailored for forex trading, and let's go through this strategy formula to judge for ourselves. So here is the formula we are going to work with for this strategy. Since we are agreed that the most common success rate is around 60%, and we will use a simple one-to-one reward to risk ratio. So 60% would equal 0.6, and the reward risk ratio would equal 1. Simple substitution would give us a result of 20% Kelly. That Kelly percent equals 20% risk of our capital on every single trade. Such high risk is not acceptable in the forex market. And further, if we changed our reward risk ratio to 2 to 1, which means that it would equal to, then Kelly's criterion would equal 40% of our capital, and that definitely is not acceptable. So we will move on to the third strategy, which is fixed fractional strategy. This strategy was introduced by Ralph Vance in 1990. In this book, Portfolio Management Formulas, he introduced this strategy, and the one thing you have to be aware of before reading that book, that it takes time to get used to Ralph Vance's writing style. But truth is, his books are very informative and educational if you can keep up with all the mathematics. This strategy increases the lot size as long as we are winning and decreases the lot size once we encounter a loss. Therefore, it works for us to maximize our profit when winning and protect us from loss when we are in a losing streak. In simple terms, fixed fractional is the percent of our capital that we are willing to risk, which we already agreed that it should never exceed 4%. Here is the formula for the fixed fractional strategy. As an example of our capital, if we have a capital of $10,000, of our capital on a single trade, and our stop loss is 50% away, then we can calculate that as follows. Fixed fractional equal 4% means that it would equal 0.04, risk in pips equal 50, and BIP value is really self-explanatory. BIP value for major pairs like euro dollar and British pound dollar, the standard lot would equal $10, mini lot would equal $1, and micro lot would equal $0.1. So the lot size would equal, at the end, 0.8 lot. If any of these calculations seems hard to understand, it's only natural. And we will go through a practical example toward the end of this webinar. And to top that, I will show you how to reach this same result knowing only 4 numbers: your stop loss, your entry point, and your profit point, and of course, knowing how much money you have in your account. So why was the fixed fractional strategy once popular? Because when we win that trade, the next trade risk would include the profit, and it will be equal to more than the $400 as per the previous example. And this is called the compounding effect, meaning that in the first trade, we risked $400. In the second trade, we would be risking $420, and so on each next trade. Experts suggested a lot of variations of this trading strategy to overcome its limitation, and we will discuss next one of the famous variations of this methodology, but just after examining the pros and cons of this strategy. The first advantage of using this strategy is its compounding effect, which guarantees exponential profit when winning and limiting losses when losing. This strategy is really simple, as it is only a matter of number substitutions. It takes practically no time to calculate, but the disadvantages of this strategy is that we will never be able to use this strategy using a standard account reliably. The second disadvantage of this strategy is that it's really hard to recover from a severe drawdown. Next, let's discuss optimal F strategy or optimal fraction. This variation of the fixed fractional strategy was also developed by Ralph Vince, and he explained it best in his book, Leverage Space Trading Model. The letter F stands for fraction, and this is when money management started to become complicated for us traders. First off, what is the optimal fraction? The optimal fraction is the specific risk percentage of a capital that will grow that capital at the most efficient rate. In other words, it's how much percentage of our capital we are willing to risk to get the maximum net return of our capital. So, in short words, this strategy tells us the shortest road to reach doubling our account or even reaching $100,000, for example. This method, while mathematically sound, but it can only be applied after you tried an analysis system thoroughly. Let's see the formula to understand why that is. To start with, we have to calculate our optimal F based on historical data. So if we don't have that data, then we would be practically unable to precisely calculate the first requirement of this strategy. Then we have to review our trading history to determine the maximum loss we endured and calculate how much in percent that cost us. Lot price should also be calculated including leverage, meaning that one standard lot would equal $100,000 if we are trading euro-dollar or British pound-dollar pairs. Let's view an example to understand this strategy. From experience, the most common optimal F for traders is a number between 0.25 and 0.3. The maximum historical risk percentage will equal 4%, since we agree that is the maximum we would be willing to risk trading. So if we follow that percentage, this is the number we would end up with. So to apply these numbers on a $10,000 capital, it will go like this. This would result on giving us that the best lot size we should trade with is 0.75 lot. Standard lot, by the way. We are not done yet. We have one more calculation to do. Now, we know that the best lot size is 0.75 standard lot. Where should we place our stop loss point? We calculate the number of bips that when reached, we lose exactly 4% of our capital, which is $4,100. So notice that in this strategy, we did not factor in a specific stop loss for a specific trade. We used a general historical stop loss. When I started comparing results between optimal F and fixed fractional strategies, I was like, using fixed fractional strategies, I ended up with 0.8 lot. And when I'm using optimal F, I ended up with 0.75 lot. This is not bad. Reality is, using optimal F based on historical loss, which we compensated for by 4%, is very, very dangerous. Money management rule is not to tell us where to place our stop loss point. Its only rule is to tell us how many lots we should trade for maximum profit. So, why we should not use a historical stop loss? First off, there is absolutely no guarantee that we will not encounter a bigger loss in the future. Based on historical loss, we don't prepare for this. If our analysis system informs us that stop loss should be placed 30 pips away and our historical stop loss is 60 pips away, then the technical analysis stop loss is 30 pips away and the historical is 60, we will be wasting profit. And this is not the right way to trade. While if the other thing happened, that our analysis stop loss would equal 60 pips and our historical stop loss would equal 30, this would result in an increased risk, meaning that our analysis could be right, but we were stopped out early because our historical stop loss informed us to do a stop loss by only 30 pips. The next strategy we are going to discuss is the fixed ratio strategy. This strategy was developed by Ryan Jones in his book, The Trading Gains, in 1999. Ryan Jones developed this strategy to overcome the problems of fixed fractional strategy that existed back then. What we will discover using this strategy is that it becomes less aggressive as the capital grows, meaning that at some point, the capital will not grow at the same rate it used to be because of the presence of the fixed ratio factor. This strategy is all about calculating the fixed ratio factor, which is called delta. So what is the role of delta? This is better illustrated with an example. If we have a capital of $10,000 and started trading one standard lot per trade, and we figured out that our delta factor is $2,000, then we would trade one standard lot until we gain $2,000 in profit, meaning that we will enter the market using one standard lot for every trade and each trade until we reach $12,000. Once we reach that number, we will increase our position size to 2 standard lots for each trade. That would happen until we reach another $2,000 in profit, and we would increase our position again to 3 standard lots, and so on. I really am sorry about that cold. If we encountered a loss bigger than those $2,000, we decrease our position size again to 2 standard lots until we gain $2,000 and move it up. The important thing about this strategy is that it does not factor in the accepted risk, which is 4%, which we agreed about earlier, and as well, it does not factor in our account capital. So how to calculate delta? To calculate delta, we have to divide our maximum drawdown by a certain number, X. That number represents how aggressive or conservative we are. So we can control that number. If we want to be aggressive, our X would equal 2. If we want to be neutral, our X would equal 1. And if we want to be conservative, our X would be 0.5. Let's take an example to reveal this much. The higher the number we choose represents aggressiveness. And to be more conservative, we would have to lower that number. So, if our maximum drawdown of a $10,000 capital is 20%, that would equal $2,000, then to be neutral, we would calculate delta as follows. Delta would equal $2,000 by 1. This would equal $2,000. Then, when our account grows by those $2,000, we would increase our position size by 1 lot. If we want to be aggressive, we would divide $2,000 by 2, and the result would be $1,000. And this means that once our account grows by $1,000, we increase our position size by 1 lot. Of course, to be conservative, it means that accounts have to grow by $4,000 before we can increase our position by one lot. Does that make sense? Exactly. Exactly right. Wait, sorry for that. Hopefully I am pronouncing it right. The problem with this strategy is that when we start with small capital, we face the problem of increased risk. In the best example, we would be trading 6 standard lot when we reach $20,000. On the other hand, we would be risking much less by the time we reach $100,000 because as our capital grows, delta or the fraction will grow accordingly. So what are the pros and cons of this fixed ratio strategy? The advantage of this strategy is that it's great for small capital. It increases our profit at start and protects our capital on the long run when we reach certain profit. The disadvantages of this strategy is that at start we face an increased risk, and on the long run we are unable to sustain such rate of growth on the capital. Now, let's move on to practical money management. This can be explained in 2 steps. Fixed fractional strategies had minor disadvantages, and these disadvantages were the main reason why money management became much more complicated. We will apply minor modifications to the original fixed fractional strategies so it provides the best fit for us forex traders. These are the steps we will follow after finishing our analysis and just before placing our trade. If you find any of these calculations complicated or even take you longish time to complete, feel free to use the calculator example that we will discuss in the practical trade we will go through in a bit. The first thing we will do is that we will check our reward risk ratio. If that ratio is lower than 1, then we will look for a different opportunity. If that ratio is higher than 1, we should proceed to the next point. Example, if we are risking 40 pips to gain 50 pips, then the ratio is almost 1.25, and that is a good ratio, and that is a good trade to follow. The second point that we would do is we would write down our entry, stop loss, and take profit point, and we will notice what currently our capital is. We will apply the formula on the micro lot size, not on the standard lot size. It really is simple as that. Now, let's go to the practical trade and see how we can even make it much simpler. This analysis was published 3 weeks ago on a Tuesday morning before London session. The setup is really simple. Confirmation is used as entry, invalidation is used as stop loss, and target is where we take our profit. Most often than not, exactly, this was the same, but we didn't have the time to discuss it back then. Sharp eye, Steve. Most often than not, I inform members to move the invalidation point closer to a certain point. Once we have confirmation, meaning once we enter that trade, we move that stop loss to this high. We will be using Elite Forex Money Management Calculator. Of course, you can use any other calculator you are familiar with. The thing is, this one is very simple, and I'm familiar with it, and it's for free. Please give me a second while I get my browser ready. So we will start by feeding the required info into that calculator. First off, currency pair, which is British pound US dollar. Entry price or confirmation point is at 1.6126. Stop loss or invalidation is at 1.6185. And take profit. We have 2 targets on that chart, and we will first do the first target, which is at 1.6067. Last thing, in the last box, we will enter our account balance, which is $10,000, and we would hit generate results. First information is about reward to risk ratio. And we now know that we have 1-to-1, and the calculator informs us that it's okay to continue with this trade. Next, we see how many lots we can trade. Of course, we are concerned with the micro lots at the lower end of this chart, of this page, and we see that we can trade 67.8 micro lots. We will round up that target to 68 lots, and we write that down and start calculating for our next target. The only field we are going to change is the take profit field, since every other criterion remains the same. So the second target is at 1.5994, and let's generate results. Now, our reward to risk ratio on this trade is 2.2 to 1. No, risk percentage is not predetermined. It's calculated based off the stop loss and our entry point. I will show you how it's calculated in a minute. You see, for the second target, the reward to risk ratio changed to 2.2 to 1. That's because we changed the take profit. Now, we can tell that this target provides us with much better reward to risk ratio. It's more than 2, which is an ideal reward to risk ratio. Since our entry level and stop loss remain the same, we end up with the same position size, which is 68 micro lot. With that, the calculator's job is done, and we move to our terminal and place our order. I'm already saying it, right? Waiting. By the time the bound reaches the second target, we lock in $897, which equals to 9% of our capital just in one single trade. If that trade did hit our stop loss, we would only lose 4% of our capital. Let's see how to use the mathematical formula. First of all, we calculate risk in pips, which equals to 59 pips. Second on, we calculate reward with the second target, which is 132 pips. Reward to risk would equal 2.2, and then we calculate the lot size based on 0.04, which is our fixed fractional, and the $10,000, which is our capital. Risk in pips, which equals to 59, multiplied by 0.1, which equals the mini lot scenario, and that would equal 0.68 lot. You see, using money management is very powerful. We gain 9% of our capital just using one trade. Just using one trade. This is the misconception that many people have about money management, that if we follow a money management system, we wouldn't be as profitable as if we didn't follow it. Using money management is really powerful for traders that have access to leverage and are showing consistency. With money management, traders don't need to go after the big windfall profit and home runs, but instead, we can focus on small conservative goals. Money management cannot turn a poor strategy into a winning one, but it can make a good strategy great. Thank you so much for being such a great audience, and I really hope you enjoyed this webinar as much as I enjoyed preparing it. Thank you so much. If you have any questions, I am here to answer them.